Welcome to economic class, session number 5. In this particular session, we are introducing macroeconomics. The objective is that after this session, you must be able to demonstrate the understanding of the nature and methodology of macroeconomics. So let's begin by looking at the macroeconomic objectives. There are basically four macroeconomic objectives, that is to achieve economic growth, control inflation, achieve full employment, and maintain a healthy balance of payment. We'll be talking about those issues in details. To begin with, in this particular session, we are focusing on national income and national income calculation. So under national income, we'll look at the circular flow of income. We'll look at national income accounting or calculations, and we'll also look at the equilibrium income or the equilibrium in the real economy. Now, we need to understand that businesses operate in the economy as a whole, and changes in macroeconomic factors or activities can have a major bearing on the performance of businesses, even government itself. So measuring national income can actually indicate how the economy is performing, and that of course will help decision makers to make appropriate decisions in relation to investment and other issues relating to performance of organizations. For government, because economic growth is important in raising the standard of living in the economy, government of course will be keen to promote economic growth. So let's look at how national income accounting figures can help decision makers. Uses of national income accounting figures. Number one, we use those figures to assess the state of the economy for the purpose of constructing economic policies. That's government, of course, using the figures for the purpose of constructing economic policies. The same national accounting figures can help government to monitor the impact of its economic policies. Number three, it can enable government and businesses, of course, to compare progress and prospect of different economies. It can also help government to establish the material standard of living in the economy. Let's look at what GDP is. The definition of GDP. GDP is simply the total value of goods and services produced by an economy in a given period. Of course, this period is a period of 1 year. So GDP, gross domestic product, is the total value of goods and services produced by the economy or an economy in a given period. Gross national product, which is GNP, is the measure of the goods and services, the value of goods and services produced by the nationals. So GDP looks at whatever is produced within an economy regardless of who is producing. So those produced products and services that are produced within an economy regardless of who is producing it are taken into consideration when you are calculating GDP. But when you are calculating GNP, you only take into account the output of the nationals. So GNP is GDP. GNP is GDP plus income accruing to domestic residents from their investment abroad, less the income accruing to foreign residents from their investment in the domestic economy. So what this means is that if we calculated GDP, say for Zambia GDP, we calculate GDP. That GDP includes the output of Zambians plus the output of foreigners who are producing in Zambia, because GDP is looking at the value of what is produced within an economy. To convert that value to the GNP, for us to be able to know the output of Zambians, whether producing in Zambia or producing from outside Zambia, we need to get that GDP and add the output of Zambians who are producing from abroad or from their investments abroad, and then subtract the output of the foreigners from their investment in Zambia. That's how we can convert a GDP to a GNP. Now let's look at the circular flow of income. The circular flow of income focuses on showing us how income flows in an economy, We know that one man's expenditure always becomes another person's income. Somebody's income is because somebody else spent the money. That's how you make your income. So one's expenditure results in another person's income, and another person's income is as a result of another person's expenditure. So let's see how income flows in an economy. So the key players in an economy are households, the households, consumers, and also firms who are the producers. But what happens here is that households supply what are called factors of production. These factors of production includes land, labor, capital, and enterprise. So households supply those factors of production to a particular market called the factor market. This is the market where factors of production are traded. Who hires the factors of production? Of course, firms hire the factors of production, and firms do not use these factors of production for free. Firms pay money in exchange of the factors of production, and so money comes to households in form of income. So the income that comes to household includes wages received as a result of supplying labor, rent received as a result of supplying land, interest received as a result of supplying capital, and profit received as a result of supplying the entrepreneurial skills. So money flows from firms to households via a market called factor market, and this money is paid in exchange of the factors of production that households supply. When firms use these factors of production, firms produce goods and services, so output comes from firms through a market called the product market or the goods market. Goods and services are supplied to households, and households are the consumers of the goods and services that are supplied. The point is, households do not use these goods and services for free. Households pay money in exchange of the goods and services, and money gets back to the firms in form of revenue. So firms pay money in exchange of factors of production to households, and households pay money to firms in exchange of goods and services they consume. That's how money flows in the circular flow of income. So this tells us that if we are to calculate national income or GDP, we can calculate GDP using three different parts of the circular flow of income. You can calculate GDP by just looking at the total income received by households, because that total income received by households will be equals to the value of the factors of production supplied to firms, and that of course will be equals to the value of the output of firms. So national income, GDP, can be calculated by looking at the total income received by households, or by looking at the value of output of firms, or by looking at the expenditure on the goods and services that are produced by firms, because the value of the goods and services must be equals to the expenditure on these goods and services. However, there are certain sectors that may influence the circular flow of income, and these sectors include government sector, the banking sector, and the international sector. So let's start with the government sector. How does government influence the circular flow of income? First and foremost, government charges taxes, which means that the income received here will not be equals to the total expenditure by households, because this income will be reduced by the amount of tax that is paid to the government. So when you receive money, that money you receive, it's called disposable income that you receive. It's the total income minus the tax. So that income is not going to be equal to your consumption expenditure because government has taken part of it, which is taxes. So that income can only equal to the expenditure when government spends the amount received from taxes on public goods, which we call government expenditure. So unless taxes equal government expenditure, then the circular flow of income will remain in equilibrium. The second sector that influences the circular flow of income is the banking sector. We also know that after government gets taxes from the income, households do not spend the whole lot of their income on consumption of goods and services. Part of the income may be saved in a bank via what is called savings. So if you save part of the income, it simply means that this income will no longer be equal to the consumption expenditure on that part, on goods and services, unless the money saved in a bank is borrowed by another person or individual or organization and they spend it in the form of investment expenditure. So for income to remain at equilibrium in the circular flow of income, the savings must be equals to the investments. Savings must be equals to the investment. Let's go to the last sector that influences the circular flow of income. That's the international sector. Part of the expenditure by households and organizations, including government, may be expenditure on imports. So imports means that money is leaving this economy to other economies, unless the cost of imports or the value of imported goods matches with the value of exported goods. When we export, that's when money comes back in this circular flow of income. So exports must be equal to imports for national income to remain at equilibrium. So this is the circular flow of income, and this is how income moves from one sector to the other sector, and from one element, households, to firms, and vice versa. So at this stage, probably we can say, let's try to examine the three sectors further. When money is coming into the circular flow, we call that process injection. And when money is leaving the circular flow, we call it the withdrawal or leakage. So for this economy to remain at equilibrium, it means that the withdrawals must be equals to the injections. Withdrawals must be equals to injections for this economy to remain at equilibrium. So something like this. Let's insert a small table that can help us. So let's say we have the sector this side, and we have the withdrawers, and on the other side we have injections. So what this means that if money is coming into the circular flow, we call that an injection. If money is leaving the circular flow, we call it a withdrawal or leakage. So from government sector, the withdrawals will be taxes. When government charges tax, income tax, money leaves the circular flow of income. So income tax, we write T for income tax. But when government spends, money gets back in the circular flow of income. So government expenditure, G, is an injection. From the banking sector, savings will be withdrawals, because when money is saved, money stops flowing in the circular flow unless someone goes to get the money that is saved and use it for investment. That's when money gets back into the circular flow of income. So savings is a withdrawal, it's a leakage. Investment is an injection in the circular flow of income. Now when we come to international sector, what we have there is imports, M, is a withdrawal and exports are an injection. When we export, money gets into this economy. When we import, money leaves the economy. So what we are saying is this, that for the economy to remain at equilibrium, the withdrawals must be equals to the injections. So one of the methods you can use to calculate equilibrium income is by saying equilibrium income, we say T plus S plus M should be equals to G plus I plus X. So for the economy to remain at equilibrium, the withdrawals must be equals to the injections. So taxes, savings and imports must be equals to government expenditure, investment expenditure and exports. That's one of the methods that you can use to calculate equilibrium income. The other method you can use to calculate equilibrium income is by saying equilibrium income is the income that equals expenditure. So equilibrium income Y is the income that equals aggregate expenditure. So that's another method you can use. So we have two methods that can be used to calculate equilibrium income. Number one is where you compare withdrawals with the injections, and then look at the fact that at equilibrium withdrawals must be equals to injections. Number two, it's where you say national income at equilibrium should be that income that equals what? The income that equals aggregate expenditure. All right, so that's how we calculate the equilibrium income. On the other part, we've already mentioned that there are three ways you can calculate GDP or aggregate demand or expenditure. Three methods that you can calculate GDP. You can either look at the income received by households in exchange of factors of production, or you can look at the value of their output or value of what has been produced, or you can look at the expenditure. So what is aggregate demand or what is aggregate expenditure? Aggregate demand or aggregate expenditure. Aggregate expenditure can be calculated using the expenditure method of calculating GDP. Using the expenditure method of calculating GDP. Three methods of calculating GDP I've mentioned. That's the income method, where you just take the income received by households, or output method, where you take the value of what has been produced by firms. But there is another method that you can use to calculate GDP, which is called the expenditure method. So what is the expenditure method of calculating GDP? The expenditure method of calculating GDP is where you say GDP equals to consumption expenditure, that's C is consumption expenditure, plus G, government expenditure, plus investment expenditure, plus net exports. That's how you calculate GDP. And this is equals to aggregate expenditure or aggregate demand. So if we say we want the value for aggregate expenditure, so aggregate expenditure E equals aggregate demand, and this also equals C plus investment expenditure I plus, of course, government expenditure can come at any position, plus net exports, which is exports minus imports. That's a net exports. So this is equal. So if we say At equilibrium, income must be equals to aggregate demand or aggregate expenditure. So what we're saying is that at equilibrium, income must be equals to this C plus I plus G plus net exports. So at equilibrium income must be equals to consumption expenditure plus investment expenditure plus government expenditure plus net exports, which is exports minus imports. That's equilibrium income. And there are a number of questions that we actually, in this particular video, we'll look at one question where we can calculate equilibrium income. Now let's talk about C in a little bit of details. C is consumption expenditure, and the consumption expenditure function is written as A plus BY. A plus BY. BY or BYD, because the Y there means disposable income. So this is the consumption function. C is the consumption function or the expenditure by households. It has got certain elements. For example, A in the formula represents autonomous expenditure. So what is autonomous expenditure? This is the expenditure at zero income. The household expenditure at zero income is called autonomous expenditure. The expenditure by household when there is no income coming through to those households. Expenditure at zero income is called autonomous expenditure. B in the formula, in the consumption equation, B represents the marginal propensity to consume. B represents marginal propensity to consume. So we have the marginal propensity to consume. What is the marginal propensity to consume? It's the percentage of income that is spent on consumption. Marginal propensity to consume, the percentage of income, every extra income that is spent on consumption. So if you earn an extra 100 kwacha and you spend 80 of it on consumption, then your marginal propensity to consume, which is the value of B, is going to be 80%. So B is MPC, or the marginal propensity to consume. That's the value of B. Now, income that is earned can either be spent on consumption or saved. So we have another situation where we say income can either be spent on consumption or it can be saved. So if the marginal propensity to consume is compared with the marginal propensity to save, you'll find that the marginal propensity to consume plus the marginal propensity to save should give you 100% of your income. So this means that 1 is equals to MPC plus MPS. So given MPC, you can easily calculate MPS by saying MPS equals to 1 minus MPC. So that's how we calculate the marginal propensity to save using the same equations. So now at this stage, I would love us to attempt a question, look at a particular question and use it as an example for this study. So we've got a question, of course, coming from one of the question papers, past question papers. It says, consider an economy with no government, imports or exports, and with fixed prices and interest rates. Let's see. Now remember what we've said about C. C is consumption expenditure. Let C be equals to 150 plus 0.60y. Let's look at this function for a moment. That's a consumption function, and we just wrote the consumption function here. So picking out this just to try and compare it with our function here, you can have a clear interpretation. Consumption function, so 150 is what we are calling autonomous expenditure, the expenditure by household at zero income. And B is what we are calling marginal propensity to consume, the percentage of every extra income that is spent on consumption. So in this case, 60% of every extra income is spent on consumption. So if you have your MPC as 0.6, what will be your MPS? MPS is 1 minus MPC. So MPS is expected to be 0.4 or 40%. Well, back to the question. So required, what is the equilibrium output, or what's the equilibrium income? What is the equilibrium income or equilibrium output? We've said at equilibrium, there are two things you can use. At equilibrium, equilibrium income must be equals to aggregate expenditure. And we know that this is the formula for aggregate expenditure. So income must be equals to that at equilibrium. Or we can say at equilibrium, the total withdrawals must be equals to the total injections. According to the information given in the question, we are going to use this model of calculating the equilibrium. So copy that formula or model, bring it here, we'll work with that. So let's see consumption function be 150 plus 0.6y and investment equals to 50. So in this particular question, we are told that we do not have government expenditure and we do not have exports. So it means that we are going to remove x, m, and g from our equation. So however, the equation will be like this. Income equals aggregate expenditure, AE, aggregate expenditure, which is equals to C plus I. Because in this case, the question is saying we do not have imports, we do not have exports, we don't have government expenditure, so we only have consumption and investment. So how much will be the equilibrium income? Y equals C, consumption function is 150 plus 0.6 y. That's C. Then we say plus investment, which is 50. What is the equilibrium income or equilibrium output? You collect like terms. This is going to be 1 minus 0.6y equals to 150 plus 50, that is going to be 200. Y minus 0.6y, you have 0.4y equals to 200. So divide by 0.4, divide by 0.4 that side, y will be equals to, you should have 500. So the equilibrium income in this economy is going to be 500. That's the equilibrium income. Part B of the question, we are told that define the concept of marginal propensity to consume. Marginal propensity to consume, MPC, is the percentage of income that is spent on consumption. Percentage of income that is spent on consumption. Number 2, what is the value of marginal propensity to consume? The value of marginal propensity to consume, we've said, is going to be calculated by comparing MPC and 1. So we'll say since MPC plus Since MPC plus MPS equals 1, MPS will be equals to 1 minus MPC. That is, MPS will be equals to 1 minus 0.6. And so MPS is going to be 0.4. That's the marginal propensity to save. The marginal propensity to consume, is 0.6. In this particular question, they just wanted the marginal propensity to consume. Wanted the marginal propensity to consume. So marginal propensity to consume, you just pick it from the question. So, right. MPC equals 0.6. MPC equals 0.6. MPC is the coefficient of y. MPC is the value of b, 0.6. Then calculate the value of marginal propensity to save. Value of marginal propensity to save. This is where you are going to say since MPC plus MPS equals to 1, MPC plus MPS equals to 1, MPS equals to 1, so MPS is going to be equals to 1 minus MPC, and so MPC will be 1 minus 0.6, MPS is going to be 0.4. So let's move on to part 3 of this question. It says, define the concept of the multiplier. The concept of the multiplier. So what is the multiplier? The multiplier is the factor by which equilibrium output changes in response to change in an autonomous variable such as investment or government expenditure. So let me just write something there. Multiplier is the factor by which equilibrium income or output changes in response to changes in an autonomous variable. Autonomous variable such as investment or government expenditure. That's what the multiplier is, the factor by which equilibrium income changes in response to changes in an autonomous variable such as government expenditure. What is the value of the multiplier in this case? So how is the multiplier calculated? The multiplier is calculated as K equals to 1 divided by 1 minus MPS. Divided by 1 minus MPS, divided by 1 minus MPC. So this can also be written as K equals to 1 divided by MPS, because 1 minus MPC is the same as 1 minus MPS, so the multiplier is 1 divided by 1 minus MPC, or 1 divided 1 minus MPS. The next question says, so what's the value of the multiplier? What's the value of the multiplier? So the value of the multiplier, you will say K equals to 1 divided by, what's the value of MPS? MPS, the value of MPS is already calculated here, which was just 1 minus the value of MPC. So the value of MPS is 0.4. 0.4 divided into 1, the multiplier here will be equals to 25. The multiplier will be equals to 25. You can actually get this question from the question paper if you have T4 Business Economics for 2013 June. That's where this question was examined. So the multiplier is 25. The multiplier is 25. So what we are saying here is, we said the multiplier is the factor by which the equilibrium income changes in response to changes in an autonomous variable such as investment or government expenditure. So if there is a change in investment, say investment has increased by 5, what will be the change in the equilibrium income? The change in the equilibrium income will be 5 multiplied by the multiplier. The multiplier is 2.5. So what will be the change in equilibrium income is that difference in the that change in the investment multiplied by the multiplier. So if investment, say, increases by 5, the equilibrium income is going to increase by 5 times the multiplier. If government increases its expenditure, say, by 10 billion, the increase in the national income is going to be 10 billion multiplied by the multiplier 2.5. So let's look at the question, the part D of the question. It says, suppose planned investment rises by 10 to investment equals to 60. Now remember that the investment was 50, now the investment is 60. Calculate the new equilibrium output in 2 ways. First, calculate the new equilibrium output using the multiplier from C. What is this multiplier? This is the 2.5. Secondly, calculate the new equilibrium or the new equilibrium output using the same procedure as you did for A, using I investment equals to 60 rather than 50. And we are told that the answer should be the same. So what method did we use in A? In A, we used the method where we said at equilibrium output, income must be equals to aggregate expenditure, and the aggregate expenditure was C plus I because we didn't have government or imports or exports. And we calculated our income was 500. That's the equilibrium income. In this one, we are told that secondly, we are going to use that model, but firstly, we have to use the multiplier model. So let's use the multiplier. So we'll say equilibrium income Y using the multiplier. What we are saying with the multiplier is that if there is a change in one of the autonomous variables, investment or government expenditure, there will definitely be a change in national income or equilibrium income. So the point here is this: if there is an increase, in one of those variables, there should be an increase in equilibrium. So the increase in equilibrium income will be equals to the increase in the autonomous variable multiplied by the multiplier. So the increase in the autonomous variable in this case the autonomous variable is investment. The increase in investment multiplied by the multiplier, multiplied by K, which is the multiplier. So this is going to be equilibrium income is going to be, what is the change? What is the increase in equilibrium income? The increase in the equilibrium income will be the increase in the investment. We are told that the increase in the investment was 10 multiplied by the multiplier. The multiplier we calculated was 2.5. And so this gives us 25. So the increase in national income as a result of the increase in investment will be 25. Increase in equilibrium income as a result of the increase in investment of 10 is going to be 25. So if we have a 25 increase in equilibrium income, it means that the income will now be equals to the one we had at first, 500, plus the increase 25. So the new equilibrium income is going to be 525. That's one way we can work out this. The second way, we have been told that you can work out this new equilibrium income using the first model we had used. So the second way, this is one of the ways. So we can say number one. So we can say first, that's the model we can use. That's the first model. Secondly, we can use the first model we had used, where we said at equilibrium income should be equals to aggregate expenditure. So we said income should be equals to what's aggregate expenditure. In that form we only had C plus I. And we are told that there is an increase in I. I is no longer 50, it's 60. So equilibrium income will be equals to what's consumption? Expenditure is 150 plus 0.6y plus, instead of 50 we have 60. So correct like terms, y minus 0.6y should be equals to 150 plus 60, that's 210. Difference between y and 0.6y, we should have 0.4y equals to 210. Divide both sides by 0.4, y should be equals to 525. This side divide by 0.4, that side divide by 0.4. 210 divided by 0.4 is 525. So the answer is the same. Second model, we've used what we used at first, equilibrium income equals aggregate expenditure, and earlier we had also used the multiplier to try and find the new equilibrium income if there is an increase in one of the autonomous factors, and in this case it was the increase in investment. Thank you for sparing your time to listen to this video. I would encourage that you go to question papers and find some questions that you can actually practice. I intend to do more questions on this one because it's mostly it's found in the exams. All right, thank you so much.